In the massive, incredibly complex world of economic forecasting, we're surrounded by noise, thousands of data points, endless expert opinions, and constant chatter. But what if I told you there's one signal, a single, elegant line on a graph that has proven more reliable, more potent than almost any other? Today, we are pulling back the curtain on one of the most accurate recession predictors in modern history, the yield curve.
It sounds a little bit like science fiction, doesn't it? A genuine crystal ball that can see through the fog of the global markets? It seems impossible. But the truly fascinating thing is that for the better part of the last 50 years, we've had something that comes remarkably close.
For over half a century, this one indicator has flashed a warning sign before every single U.S. recession. It doesn't ring a loud alarm bell, it doesn't shout from the rooftops, it just quietly, subtly changes its shape. And when it does that, well, history tells us that we absolutely have to pay attention. This is the story of that signal. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
All right, so how are we going to tackle this? Here's the roadmap. First, we'll ask the big question. Is this really the ultimate recession signal? Then, we're going to decode what this term inversion actually means. From there, we'll look back at its history of warnings, lay out the real recession timeline it predicts, and then we'll tackle the huge debate raging right now. Is this time different? And finally, we'll put it all together to figure out what the curve is telling us.
So let's start right there. With all the data flying around, consumer confidence, jobless claims, manufacturing reports, why does this one indicator get so much attention? Why does it command so much respect? And frankly, so much fear? The answer is simple. It's track record. It is, and I'm not exaggerating, stunningly accurate. Think about it like this. Imagine you had a weather forecast that didn't just tell you it might rain tomorrow, but had successfully predicted every single Category 5 hurricane for the last 50 years, giving you a heads up months in advance. That's the kind of reputation the yield curve has earned. It's not just another piece of data. It's a reflection of the collective wisdom and the collective fear of the entire bond market, which is arguably the smartest money in the world.
Okay, so to really get a grip on its power, we have to learn its language. And the one word you hear over and over again is inversion. So what is a yield curve, and what in the world does it mean when it inverts? Let's break it down.
At its most basic, the yield curve is just a line on a chart. Seriously, that's it. It plots the interest rates, or the yields, that the U.S. government pays to borrow money over different periods of time, so from just a few months all the way out to 30 years. Normally, this makes perfect sense. If you were to lend someone money for 30 years, you demand a much higher interest rate than if you were lending it for just 3 months, right? You need to be compensated for tying your money up for that long. The yield curve simply shows that same common sense logic for government debt. And this right here shows the two states of the world. On the left, you've got a normal, healthy economy. The line slips up, you get paid more to lend for a long time. Simple. Investors are optimistic about the future. But on the right, that's when things get weird. The curve inverts. It flips upside down. Suddenly, the market is telling you that you'll get paid a higher interest rate for a short-term loan than a long-term one. That is completely backwards, and it's a massive red flag that investors are deeply, deeply worried about the immediate future.
And that leads us to the real million-dollar question. Why? Why does the strange flip in interest rates have such a powerful, almost prophetic ability to predict a major economic downturn? Well, it's not magic. It's actually baked right into the plumbing of our financial system.
There are really 3 big reasons this works. First up, market expectations. An inversion is the bond market shouting that it expects the economy to get so weak in the future that the Federal Reserve will have to step in and slash interest rates to save it. They're pricing in a future rescue mission. Second, and this one is absolutely crucial, is how it affects banks. The entire business model of a bank is to borrow short and lend long. Think about it. They take your savings, a short-term loan to them at a low interest rate, and they lend it out as a 30-year mortgage at a much higher long-term rate. The difference between those two rates is their profit. When the curve inverts, that profit margin disappears. Sometimes it even goes negative. So what happens? Lending becomes unprofitable. Banks pull back, credit tightens, and the economy gets starved of the capital it needs to grow. It's like turning off the water main. And finally, there's pure investor sentiment. When big institutional investors get scared, they don't buy stocks. They run for safety. And the safest asset on planet Earth is a long-term U.S. Treasury bond. This massive wave of buying pushes the price of those bonds up, which in turn pushes their yield down, helping to create the very inversion that signals their fear.
So we have the theory. We understand the mechanics. But that's all just theory.
Where the yield curve really earned its reputation is in the real world. So now, let's open up the case file and look at the cold, hard data from history.
This right here, this is the statement that everything else is built on. I want you to let that sink in for a moment. Not most recessions, not a lot of them, every single one for more than 50 years. The oil crisis in the 70s, the dot-com implosion in 2001, the great financial crisis of 2008, the short COVID recession of 2020. The yield curve inversion showed up first every single time, sounding a quiet but persistent alarm.
And this chart is where the proof becomes impossible to ignore. Look at the lead up to the 2008 crisis. The yield curve inverted way back in August of 2006. The warning shot was fired. But what happened in the stock market? It kept partying for another year, hitting all-time highs, completely ignoring the signal. But the bond market, the so-called smart money, already saw the deep cracks forming in the foundation of the financial system. The recession didn't officially begin until January 2008, a full 17 months later. You see the same pattern over and over again. The signal is a forecast, not a news report. It tells you what's coming, not what's happening right now.
And if you take all these historical examples and you average them out, you get about 12 months. That's a really critical number to keep in your head. The inversion basically starts a countdown clock. But it's not a precise clock. It's a clock that tells you a recession is now highly likely sometime in the next 7 to 24 months. This quote really just hammers it home. It summarizes the sheer weight of all that historical evidence. It's why anyone who dismisses the signal out of hand is effectively arguing against a half-century of consistent, powerful, and frankly undeniable data. That track record points to a near-certain warning of economic turbulence ahead. And navigating that turbulence is key to financial security. Before we continue, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
So, we've firmly established the inversion is a leading indicator. It comes first. And that brings us to a really important nuance that a lot of people miss: the actual sequence of events. It's not just a simple on-off switch. It's a process, a kind of four-act play that has repeated itself over and over again.
So what does this process actually look like? Well, first, step one, the yield curve inverts. The countdown clock starts ticking. Then comes step two, the waiting period. And this is the deceptive phase. The economy might still seem fine, stocks might even go up, but that clock is ticking away for anywhere between 7 and 24 months. Then you get to step three, and this is the plot twist. The curve uninverts. It steepens and goes back to a normal, upward-sloping shape. And it's often right after this happens, this apparent all-clear signal, that step four finally arrives. The recession begins.
This point is so incredibly important. It's the part that trips almost everyone up. People see the curve go back to normal, and they breathe a sigh of relief, thinking the danger has passed. But in reality, the uninversion is often the final warning shot. Why? Because the reason it's going back to normal is that the Federal Reserve has finally seen the trouble that the bond market predicted a year ago, and now they are in a full-blown panic, aggressively cutting short-term interest rates. The return to normal isn't a sign of economic health. It's a sign the patient has just been rushed into the emergency room.
All of this history, this clear, repeatable pattern, brings us to today, and to the single biggest debate in all of economics right now. Because the yield curve inverted again in 2022. It went deep, and it stayed there for a historically long time. And yet, a recession didn't immediately follow. This has led everyone to ask the four most dangerous words in finance. Is this time different?
So let's trace this recent, strange timeline. In October 2022, the curve inverted, and it wasn't a small inversion. It was a deep and sustained one. All through 2023, it stayed inverted, screaming its historical warning for one of the longest periods on record. And yet the job market stayed strong, consumers kept spending, and the broader economy, for the most part, defied gravity. If we project forward and imagine the curve finally normalizes late in 2025, and by early 2026 there's still no officially declared recession, well, that would be a major break from the historical script.
This really is the central mystery we have to solve. Did the undefeated champion of economic forecasting finally lose a match? Or are there new, powerful forces at play in the modern economy that are distorting the signal, or maybe just delaying the inevitable outcome?
So, what are the prime suspects for why this time might be different? Well, first, you have the 800-pound gorilla in the room, quantitative easing, or QE. For years, the Federal Reserve acted like a giant vacuum cleaner, sucking up trillions of dollars of long-term government bonds from the market. This massive artificial demand pushed the price of those bonds up, which mechanically pushes their yields down. So it's possible that QE has been holding down the long end of the curve, making an inversion easier to trigger and potentially causing a false signal. Then you have global capital flows. In a chaotic world, U.S. debt is the ultimate safe haven asset. So when there's trouble in Europe or Asia, trillions of dollars come flooding into U.S. bonds, again pushing down long-term yields. These unprecedented forces, which didn't exist in the same way in the 70s or 80s, could be warping a signal that was born in a very different financial era.
And this is exactly why smart analysts never ever rely on just one instrument. You need a whole dashboard of gauges. The yield curve is your long-range radar. It sees things far out on the horizon. But you also need to look at something like the leading economic index, the LEI. The LEI is a mix of 10 different data points, things like new manufacturing orders, building permits, and stock prices, all designed to look ahead. For a long time, the LEI was also flashing red, which provided some powerful confirmation for the yield curve's warning. And then, of course, you have the jobs numbers. Employment is what we call a lagging indicator. It's usually the last domino to fall. But when unemployment starts to consistently rise, that's the final, undeniable proof that the recession isn't on its way anymore. It's already here.
So, after all of this, after looking at its mechanics, its flawless history, and the current controversy, what's the final verdict? How should an intelligent observer, how should you, interpret what the yield curve is saying today?
This is the most balanced way to think about it. The yield curve is a powerful probabilistic warning. It dramatically increases the odds of a recession happening in the medium-term future. It is a clear signal of rising stress underneath the surface of the financial system. And it is one very important piece of the puzzle. But what it is not is a precise calendar appointment with a downturn. It is not a guarantee of immediate economic doom. And most importantly, it is not a crystal ball that you can read all by itself.
A modern framework for looking at risk might look something like this. You see, the yield curve inversion is still the biggest piece of the pie. It gets the most weight. But you have to combine it with other signals. Is the LEI also pointing down? Are credit spreads, the extra interest that risky companies have to pay to borrow, blowing out? Is consumer and business sentiment falling off a cliff? A true high-conviction recession call only comes when multiple slices of this pie are all flashing red at the same time.
So let's just boil it all down to 3 key takeaways for you to remember. Number 1, it's a leading signal. It tells you what's coming, not what's happening now. The party can keep going for months after the warning is sounded. Number 2, it's not infallible. Its historical record is incredible, but structural changes in the economy mean we have to interpret it with more care than ever before. And number 3, the timeline is a range, not a fixed date. The signal points to a window of heightened risk, usually about 7 to 24 months out. As we've seen, understanding these signals is crucial for financial planning. Before we go, don't forget to like, share, and subscribe. And for help navigating your own financial future, check out the links in the description if you're looking for a real estate agent or need life insurance. My team and I can help you anywhere nationwide.
So in the end, the best way to think about the yield curve isn't as a magical crystal ball. It's more like a fever gauge for the economy. For well over a year, that gauge was reading at dangerously high temperature, signaling that something was wrong deep inside the system. Now it appears to be cooling. So the final multi-trillion-dollar question we're left with is this. Has the fever truly broken, and has the patient made a full recovery? Or is this just the calm before the storm that the yield curve has so reliably predicted for the last 50 years?